We have a very special episode for you today of Power Charting. My name is Bruce Fraser. I'm your host. Our special guest will be Martin Pring. He is going to speak on the financial market outlook for the first half of 2021. Martin and I recorded this episode a few days ago as part of a presentation at the Technical Securities Analysts Association of San Francisco. Martin has agreed to allow a portion of his presentation to be presented today on power charting. And in just a moment, we will start that video presentation. The entire presentation can be seen at the tsaasf.org website. It's free. Right on the homepage, go there and you'll see about 25 minutes of this presentation today. The rest of it is recorded and posted at Technical Securities Analysts Association. And you'll want to go watch the rest because in the second part, he talks about the commodity market, which is just fascinating at this moment in time. And as you know, Martin is a really big picture thinker, big picture strategist, and you're going to really enjoy his perspective on the outlook for the markets ahead. Now, there's two parts to this presentation. Martin and Joe Turner would get together and present at the beginning of the year. Martin would talk on the financial market outlook. Joe would talk about the portfolio implications and talk strategy and tactics in portfolios for the changes that were coming or were taking place. This is going to happen. Joe Turner and Jim Kopas, portfolio managers at Pring Capital, on January 26 will present part 2 of this series as a live webinar. You can register for this live webinar on January 26th at tsaasf.org. So when you go to watch the second part of Martin's presentation, just register for this free event. The TSAASF is a not-for-profit organization devoted to technical analysis education. It's a great organization, all run by volunteers, and you are encouraged to become a member. So also the TSAASF is a member of IFTA. So as a member of this organization, you also get the sister membership to the International Federation of Technical Analysts. Well worth it. To learn more about Pring Capital and to learn more about Joe and Jim, go to pringturner.com and you'll be able to see their blog posts, newsletters, and other content that they put up. It's a great organization. And with that, let's get started with today's video. Welcome to the first event of 2021 for the TSAASF. As a tradition, we have as our first guests in the new year, Martin Pring and Joe Turner. This year, because of scheduling issues, we're doing it a little bit differently. We are having Martin Pring make a presentation on his research in the first part of the webinar, which is going to be recorded. In the second part, Joe Turner will come on live and talk about the portfolio management implications of the research that Martin is going to present. And so stay on after you listen to this recording with Martin Pring for Joe Turner's presentation. And with that, I would like to introduce Martin Pring. Martin, thank you so much for being here.
My pleasure, Bruce.
Now, I also want to point out that besides Martin being a principal at Pring Capital Group, he also is the author and editor of the Intermarket Review. And I would heartily suggest that you all go to his website and have a look at that phenomenal publication. So much of the work that he does goes into that publication, and the research that you see tonight is certainly inspired by that work. So Martin, how long have you been publishing the Intermarket Review?
Since 1984.
Wow.
It's a long time.
Long time. It's a remarkable piece of work, and everybody's got to take some time to go look at that.
Every 10 years, Bruce.
Yeah, say that again. Every 10 years, what?
Name every 10 years.
Well, I have had the great fortune to have Martin as a friend, mentor, and partner for many, many years. I think we're looking at 40 years now, Martin. And so
I think we are, Bruce.
And I'm blessed to have this wonderful friendship. And please share your wisdom about the markets with us now, because I'll just keep gushing if I don't stop.
Well, it's great talking to you again, Bruce. And I've enjoyed our friendship very much.
Thank you.
So this afternoon, I'm going to be talking, well, I guess it's this afternoon. That's when I'm doing it. I'm going to be talking about the influence of the financial markets, or the influence of the business cycle on the financial markets, because I think the business cycle is the largest and most important extraneous force that affects the course of the primary trend, as you might say, for bond, stocks, and commodities. So I'd like to say, spend a few minutes talking about the business cycle, just so you know where I'm coming from in terms of what you might call the GPS of the whole thing, or the framework. So the business cycle is nothing more or less than a set series of chronological sequences alternating between growth and contraction. And every 4 years, we seem to get a contraction of some kind. And the financial markets, the bonds, stocks, and commodities revolve around that. You've all heard of, I'm sure, of the leading, the lagging, and the coincident indicators. Well, those are just three of the sequences that take place during the business cycle. There are many, many, many more. But the important thing is that the turning points of bonds, stocks, and commodities also fit into the business cycle. So, for example, during the onset of the recession, bond prices bottom out as interest rates peak, because at that point in the cycle, demand for credit comes down and the supply provided by the Federal Reserve goes up. So whenever the supply goes up and the demand goes down, the price comes down. The price of credit, of course, is interest rates. So interest rates fall for a while until we get to the point in the cycle where we have the maximum downside in terms of momentum. And at that point, the players in the stock market begin to anticipate the next recovery and buy stocks when the news is blackest, not when the news is better. And then finally, we get commodity prices bottoming out as the supply and demand for commodities comes more into balance on the demand side. So at that point there, you've got three markets going up just as we come out of the contractionary phase. So it's a great party going on, but as with all parties, it must come to an end. So that happens as the economy begins to pick up some strength, and the Federal Reserve is not tight in its monetary policy, but it's less accommodative. And of course, at the same time, demand for credit is picking up because the economy is picking up and bonds peak out. But at that point, the fact that interest rates are going up is not a bad deal, because it indicates a healthy economy. So, and profits are going up faster. So the stock market continues to move up until it reaches the peak in terms of the maximum growth path. And then stocks peak out. And finally, you see commodities peaking out. So here we have three markets. Each has two turning points. And that gives us 6 stages to the cycle. And that's what we've done here. We've color-coded them for you. Stage 1 is when bonds bottom. Stage 2 is when stocks bottom, and stage 3 is when commodities bottom, and so forth throughout the cycle. And the reason we split it into 6 stages is because the calendar year, for example, is split into 4 seasons. And each season is suitable for doing certain things, certain tasks, especially if you're a farmer. Well, the same thing is true in the investment environment. Stage 1 is suitable for bonds, and for interest-sensitive stocks. Stage 2 is suitable for stocks, commodities, and for bonds, stocks, and for stocks and bonds. Stage 3 is suitable for commodities, bonds, and stocks, and so forth. So there's a point in the cycle where only commodities are doing well, or another point in the cycle when only bonds are performing well. So the point is, how do we know where we are in a cycle? How do we know where the GPS is? Well, in this sense here, what we do at Pring Turner is we have 3 models, one for bonds, one for stocks, and one for commodities. When they're all bullish, that puts us in stage 3. And when commodities are bullish and stocks are bullish, the bonds turn bearish, that puts us in stage 4. And right now, our models are suggesting or indicating that we're either in the last phase of stage 3 or the early phase of stage 4. So if we're in stage 4, that means we should be looking at a reversal in the bond market. So let's just take a look at that. And one of the ways we can look at that is to take a global indicator measuring commodities against bonds, the ultimate inflation-deflation relationship. So when it's going up, it's inflationary because it's favoring global commodities. When it's coming down, it's deflationary because it's favoring global bonds. A few weeks ago, it broke above this little downtrend. I call it a little downtrend. It's actually quite a long one. It's about 4 years in length, but this is a long-term chart. So a small amount of space takes up a lot of time. So it broke above the downtrend line and above its 12-month moving average. And also giving it credibility is the fact that the long-term KST turned up. Now, if you're not familiar with the KST, it's very simple. Just think of it as a long-term smooth momentum indicator, similar to a stochastic or an MACD. If you want to learn more about it, it's written up on StockCharts.com, and we also have articles on it at Pring.com. But by and large, you think of it as a stochastic or as an MACD, a very long-term, deliberately smooth indicator that gives you signals once every 2 years or so. And it kind of gives you signals of a primary trend proportion. So it broke above that downtrend line with the positive KST. And you can see here how previous KST signals have done pretty well in the past. That takes it back to 1993. Now we have a red arrow here to indicate a failure. It went up for a few months, but a few months in this game isn't what I would call success. We need to go for at least 6 or 9 months on the upside. So what we're seeing here is that the global commodity bond ratio has broken its downtrend line and now stands at very important resistance in terms of that bigger trend line going back to 2011, 2012. I think it's going to go through because that KST is already in a bullish mode and it's not like it's overextended or anything. And if that's the case, that will indicate that the global environment, that will confirm really, because we're already getting the indication. It'll confirm that the global environment is going to favor inflation-sensitive assets over their deflation counterparts. So let's take a look at bonds. If you recall from my 6-stage analysis, we said our models were either at the end of stage 3 or the beginning of stage 4. In other words, we're ready to see bond yields begin to rise for the cycle. Now this chart here shows the 10-year yield, and the green highlights indicate when the 10-year yield is above its 12-month moving average, like this, and when the KST, the long-term KST in the bottom panel, is above its moving average. Red is when they're both below, and black is when there's a conflict. Well, right now you can see it's moved in December, I should say, from the red bearish mode to the conflict mode, black, because one of the components is bullish for yields, which is the relationship between the yield and its 12-month moving average. And the other one is almost there. The KST is not quite above its moving average, but given the weakness we've seen in bonds in the opening week of January, it seems very likely we're going to get a signal which would give us a buy signal for the 10-year yield in terms of buying the yield. And that would be consistent with where we expect our models to go. So it seems fairly obvious here that we're at the end. We're in the beginning of stage 4, which is bearish for bonds, bullish for commodities, and bullish for stocks. And that's how we go into 2021 with that kind of environment.
Martin, can I ask here regarding that chart? Very long-term secular downtrend in yields starting in 1980 and very persistent decline. And then right here in 2020, there's just this climactic collapse of yields in the year. And I'm wondering if you draw any conclusions about this long-term trend from the sheer nature of the drop that occurred here most recently.
Yeah, well, the way I would look at it, Bruce, is to actually take a long-term rate of change. And sometimes on these secular moves, you see these long-term rates of change reach extraordinary levels. And it did back in the spring of this year. So that suggests to me, it gives me one piece of evidence that secular or very long-term trend has probably reversed. But we need more proof than that. Unfortunately, we're talking about trends that last 30 or 40 years, and we just don't get the signals, a few weeks after the final low, unfortunately.
Sure.
I think
just an epic downtrend. Yeah. So
and that collapse, I think, is probably indicating that we're at the end. We've already reached the end of that secular downtrend, and we should now be looking in the other direction.
Well, that's profound. That I know you're looking for additional confirmation, but that is quite a remarkable event.
Yeah, and one of the areas I would look for is a secular indicator for bonds. I've got one for commodities, so I will talk about it a little bit later, perhaps.
Wonderful.
Okay. So we looked at bonds, and now we take a look at stocks. Again, we'll go to a global measure here. This time we're looking at the MSCI World Stock ETF, and I've deflated it by the G20 CPI. Because if I'm looking at stocks on their own, they zigzag up higher. But in this case here, what you see we've had is a resistance level in terms of purchasing power of stocks globally peaked in 2000. So basically, we haven't gone anywhere in terms of global stocks since the year 2000 when adjusted for inflation. But look what's happened in the last couple of months. It's really broken out very sharply to the upside. This is a pretty good trend line because it's been touched or approached on numerous occasions. See how it keeps turning back all these rallies, and even had one earlier last year. So it's broken to the upside. We've also got the KST giving us a buy signal, and I can put in the other buy signals, and most of them were followed by pretty good advances lasting at least a year or more. And then there's a couple of failures. And the most notable failure here was, of course, just before the pandemic hit last year, momentum started to turn up. The economic indicators have started to turn up, and then everything literally turned on a dime. And technically, that's something I never like to see, is when an indicator makes a new high, as this one did here, and it's barely above zero. That indicates virtually no upside momentum when you're in a potential breakout position. And that's not good. As long as it's going up, of course, that's fine. But when it starts to turn down, that's something when you get an above average move as a usual occurrence. So looking at the US stock market, what I've got here is inflation adjusted S&P Composite in the top. And underneath, I got two valuation measures, the Schiller PE ratio and the S&P dividend yield. And to keep everything moving in the same direction, I've inverted the dividend yield. And the idea here is that with the current reading of 33 on the Schiller and 1.65 on the yield, we're at historic levels. We're above 1929 here on the Schiller PE, which is, I believe, was around 29 or 30. And the 1920 peak on stocks was in the 2 to 3% yield area. So it's a very dangerous territory. Only once surpassed, and that was at the height of the, tech boom. And so that means we're at very overbelieved, very dangerous levels. But I'm more concerned with the trend than the level. When the trend starts to reverse, that's when I start to get concerned about the level. Because you can see here, it's possible sometimes to draw some nice trend lines on the Schiller, and when the trend line is violated, like this one was here, you get a nice rally, and this one was violated here, you get a nasty multi-year correction. Well, looking at the latest situation, the latest data for December, you see that both series have broken above this trend line going all the way back in the case of the Schiller to 2000 and back to 2001 in case of the dividend yield. And that suggests to me that the yield is going lower, because remember, this is plotted inversely. So this series is going higher and the Schiller is going higher. And as long as they continue in that mode, I think that's a bullish situation, even though it's at a very risky level. So basically, one of the themes for 2021 is, it seems to me, is it's going to get much more speculative than it has so far. And also the breakouts above the trend lines indicate some solid strength in the period ahead, because these are multi-year consolidation patterns here.
So much of the rationalization for the paying these high prices for stocks on a valuation basis is because yields are so low on bonds.
Well, that's right. The Fed's forcing you to go into the stock market. That's what it's all about. Yeah, absolutely.
Sure. So if there is some kind of a commitment to rising rates by the Treasury market, that could be the thing that starts to make these rising relationships with very expensive stocks look a little difficult.
Yeah, I think that's true. But right now, I'm not very concerned, because we've just seen the breakout. And as long as it continues, and it's a major breakout, so it suggests to me we're going to see an extended trend on this.
Excellent.
So the next chart shows the S&P Composite, and underneath is a KST of a ratio, and that ratio is the yield, the dividend yield on the S&P to the interest yield on Moody's AAA corporate bonds. And the idea here is that when you get to the part in the cycle where stocks begin to outperform bonds, that's a relatively early part of the cycle, and it gives you a rising KST. So when the KST starts to turn from a low level and starts to reverse, that gives us a buy signal. So even though we've come up 75% from the low last year up here, there's a lot of indicators which are only just starting to turn bullish. And you can see also from that diagram of the business cycle that we're still at a relatively early stage, because stage 4 and stage 5 are usually quite lengthy stages. So if you look at what's happened in the past, for all the reversal signals that have taken place from at or below this green horizontal line, you can see they're all followed by a nice rally in the stock market. Some really good ones, like 1932 to 38, and some a little bit smaller. And then there are always exceptions, and there was an exception here in 1938, 39, where the market just went sideways for a while. But basically, since 1898, if you want to be specific, every time we've had one of these signals, we've had a worthwhile rally in the stock market. So it's got a very, very consistent record. So too does the next one we're looking at. This one is the S&P compared to a diffusion indicator that monitors a group of a universe of S&P industry groups that are above their 40-month moving average. So it doesn't give a signal very often, but when it does, it usually has a very positive effect on the stock market. So here you can see we got a tentative reversal in December, and with January's action so far, that is going to make into a more decisive signal. And then we can look at the other signals very quickly that came along, and most of them are followed by a pretty good advance, as you can see from all these. If you look to the right of the tips of all these green arrows. So this is only just giving us a signal. And remember, this is a 40-month moving average crossover. So it's kind of tied into the 41-month cycle low that we see for the business cycle. So that's one of the things that makes it a very useful indicator. As with all indicators, nothing is perfect. There is no holy grail. And we have three exceptions here, once again, back in that 1938 period, and then most notably at the 2000 top. But most of the time when this indicator turns, the vast majority of situations, the probabilities favor the market rising for at least 6 months to 18 months or so. And looking at 2021, that should be a favorable factor. Margin debt's another interesting concept. Here we got the S&P on the top, and we got the ratio of margin debt to GDP underneath, just to give us some idea of perspective of how important margin debt is towards the economic system. Rising margin debt is very bullish because it indicates that money is flowing into the market from that margin debt. And also because it reflects the fact that investors and traders are growing more and more confident. And that's what we need in order to get higher stock prices, is greater and greater confidence. Now, sometimes it's possible to construct some trend lines on this margin debt to GDP ratio. And when the trend line's violated, you can see from these arrows here, the stock market has had a very good advance. Well, guess what? In December, we got a very sharp increase in margin debt. In November, we had a very large increase in margin debt, and it enabled the ratio to break above this 20-year consolidation pattern. So here's another multi-year breakout, similar to the one that happened in the 1990s and the one in 1982-83. But there's more. And that is the fact that the KST indicator for the ratio has given us a buy signal too. So that gives us confidence that this breakout is not going to be a false one like it was in 2017, but a more valid one. And if you want to look and see what the record of the KST buy signals was in the past, here they're lining up with the KST buy signals, so they just put them underneath the S&P Composite. You can see that in every case that we've got here, market moves significantly higher. There's always an exception, and that one occurred in 1981-82. So all in all, these indicators are only just starting to turn bullish for the market, and we got that big global breakout, which suggests that the market's headed higher on a multiple year basis. One final stock market indicator is this one here. Here we have the S&P Composite, and also with it is the momentum for the financial sector. Now, this is not regular momentum. This is the long-term KST for the relative strength line of the S&P financials. So when this line is moving up, this red line is moving up, it means that the momentum for relative action for financials is rising. And you can see that we've got a signal here where the KST has only just started to reverse to the upside. So what happens in the past when financial relative strength is in a strong position, a rising trend? Here we see the low, and you can see what happens to stocks. There's the low, there's stocks, there's the low, there's stocks, so forth. All the way through, except for the year 2000, when the relative strength bottomed and the market came down. And that was the only exception since the 1980s. So it's just turned bullish again right now. And that, to me, looks positive for the stock market. And of course, since this is relative momentum, it's also positive for financial stocks in general, which have been real dogs in the last 3 years or so in terms of relative action, because here's the peak and there's the trough. It's been a very, very weak showing for financials, and that looks like it's going to change.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.